By some perspectives, the prospects for sub-Saharan economies are fairly positive. The latest individual, or rather institution, to make that prognosis is Moody's. It's projecting a 5% growth rate for the region as a whole. What exactly, however, is driving this growth, and will it be able to continue at a time when Europe and China as well are slowing down? We'll be diving into the numbers in the course of this edition of Global Business Africa. I'm Ramah Nyang in the Kenyan capital, Nairobi. Welcome to the program. We'll also be looking at investors and government representatives in Africa. They're in London for mining summit. We'll be talking to Kenya's mining cabinet secretary. We'll also be in Zambia looking at plans there to turn tons of garbage into a source of badly needed energy. Now let's start with Moody's. The ratings agency forecasts that economies in sub-Saharan Africa will grow collectively at an average rate of 5% this year. Now, economists are arguing that growth will be driven in part by strong infrastructure investments, structural reforms and competitive gains from currency depreciation. Andrew Thompson starts us off tonight with the details.
Sub-Saharan Africa will remain the world's second fastest growing region after developing Asia. Moody's notes that a robust emerging market demand for the region's commodities, strong infrastructure, spending and ongoing regulatory reforms are some of the factors driving growth this year.
From an economic growth perspective, we still expect Sub-Saharan Africa to be the second fastest growing economic region globally in the year ahead. That's underpinned by strong infrastructure expenditure, still reasonably robust commodities, demand from emerging markets, the extent to which governments are instituting structural reforms to enhance the business climate, and also the rising middle class that is a longer term impetus to growth.
Moody's has stable outlooks for 13 of the 17 sub-Saharan sovereigns it rates. Côte d'Ivoire and Senegal both have positive outlooks, while Angola and Ghana have negative outlooks.
We're certainly seeing pressure on Angola that underpins our negative outlook on the BA2 rating because of the extent to which lower global oil prices are affecting government revenues and growth in the economy. Not quite translating as much into the BA3 rated sovereigns of Nigeria, Congo and Gabon, other large oil producers, but more tolerance at the lower rating level. From a growth perspective, the non-oil producers, we expect to see an impetus from growth from the lower oil prices. It means consumer demand can be stronger, less money spent on fuels and instead spent on other forms of consumption that helps drive domestic demand locally.
The rating agency says that fiscal vulnerability, insecurity, sliding commodity prices, political uncertainty and macro headwinds pose challenges of different magnitudes to the region's economies. Sub-Saharan Africa is poised to attract foreign investors moving forward, even as financial inclusion deepens further and incomes continue to increase. Andrew Thompson, CCTV.
Now, still on Moody's numbers, it's forecasting that East Africa's economies will keep growing at between 5 and 10% this year, despite several global economic headwinds. Now, a combination of lower oil prices, diversification of economies from a heavy reliance on cash crops and a steady inflow of investments are some of the factors behind that expansion. That said, as far as East Africa is concerned, election uncertainty this year in Burundi and Tanzania, combined with rising debt to GDP ratios in Uganda and Kenya, are all cause for concern.
Over the years, these economies have managed to diversify to an extent that there are a lot more sources of growth that are supporting the growth prospects going forward. I think the economies are quite different. Kenya has traditionally had a very strong manufacturing sector, and it's very kind of outward Africa facing, and exports. Kenya exports have continued to, regional exports in particular, have continued to play a very strong supporting role. I think what the three economies also have in common, and what we've seen here that's different to the rest of Sub-Saharan Africa, has been this strong growth in a domestic consumer class and a very strong contribution from domestic consumption, which has buffered these economies when external demand has slowed down, and that's something that we'll continue to expect in coming years.
Now then, Kenya is one of a host of African nations attending this week's Mining on Top Africa Summit in London. It brings together a variety of investors and government representatives to develop the continent's mineral sector. Now, a few years back, Kenya's mining sector looked set for significant growth, with an array of international companies having signalled their interest in putting the money into the region. With fairly promising gold, iron ore and mineral sands discoveries, there's no shortage of potential. In 2013, the international miner Base Resources started production at its $300 million titanium mine on Kenya's south coast. Since then, however, investment has slowed down. However, the nation is on the verge of passing a new mining law aiming at attracting more investment and streamlining procedures and ensuring the local communities benefit a lot more from mining. Let's jump straight, of course, into Kenya's mining sector. Najib Balala is a cabinet secretary in charge of that particular sector. He's live with us in London right now. Thank you for your time, Mr. Balala. When do you expect the Senate to approve the mining bill and then send that off to the head of state for approval?
Well, we have agreed with the Senate that we have compromised everything, and we are in agreement with the Senate on the bill. What we are waiting is concurrence of the House. This is a constitutional bill, so by 27th of August we should have this bill approved and assented to.
Do you anticipate any feuds whatsoever to emerge between both houses of parliament? Because we have seen disputes emerging on things like the division of revenue bill, year in, year out. Will this be a problem?
No, because we have agreed. I have agreed with the National Assembly. Everything is in order. What has been changed is minimum in the bill by the Senate, which is the right of the Senate to do, and it's according to the Constitution. So I don't see any dispute or mediation required for this bill. Immediately it's passed by both houses. His Excellency the President Uhuru Kenyatta will assent to the bill.
Right, let's talk about your dispute with Base Resources. Value-added tax and royalties are mutually exclusive, yet in May you publicly questioned why Base Resources had applied for VAT refunds. Why was that?
Well, first of all, Base Resources is among the companies that is doing mineral sands in Kenya. They had an agreement before. That agreement needed to be renegotiated, which they have accepted. So we had an amicable understanding of renegotiations of the royalties. We have now come to an agreement of a 5% royalty, and we have agreed in principle. We have not signed off yet. So we are still engaging in those discussions. But what we are saying, whatever we have agreed in terms of 5%, can that be paid within the stipulated days or months? So we are waiting for those payments to be done. What has been paid is just 50% of it, but hopefully it can be cleared by end of this month.
Walk us through the problem here, because as I understand it, Base Resources had been given a series of tax concessions by the Treasury, 2.5% royalty rate and a 15% corporate income tax rate as well. So if Treasury's agreed to one thing with them, how then does your ministry come in and then override that agreement?
Well, all agreements have clauses of renegotiations. What they have done, Base Titanium, is they have renegotiated the same agreement 3 times. The Kenyan government has never renegotiated anything yet. So what we have done is that we have invoked the same rule, and it was agreed amicably, and we renegotiated, and we all agreed that it's going to raise from 2.5% to 5%. So that is what we have done. And remember, mining of mineral sands is only 40 kilometers away from the port of Mombasa. So in terms of investment of infrastructure, Base Titanium does not have any cost of incurring in infrastructure. So that is almost just an open pit mining, which is scooping, and then it is just shipped to the port. So that is appropriate. Today's royalties in the world is starts with 10% in Australia, and when you do a value addition, it comes to 5%. So we are in the average rate of 5%, like any other country in the world.
But where then did this argument over the VAT refunds come from, Mr. Balala? Because at the end of the day, as a company that has put money into the country, they do have a legitimate right to claim VAT refunds from the Kenyan government, do they not?
Rama, I want to say that we are not interested in discussing our company's issues on the national television, international television, like CCTV. I think it's very important to understand that we have dialogue, we are engaging, we have not gone against any legal procedures. They're entitled to a VAT refund, but not what they have requested of 2.3 billion. What they're entitled is Treasury is communicating to them. The principle is that when you pay government 200 million and then you are demanding 2.3 billion Kenya shillings, that is the principle of it, and we are working on it. But more important, Ram, I want to mention here, is that we are developing a framework that is going to be good for investors in three principles. One is stability and predictability, two is transparency, and three is equity sharing with the communities. Because if we want to avoid a mineral curse in Africa, then let's pay fairly to the country so that the country can share those proceeds with the community. And this is what we are going to create harmony and avert any curse notion on the mining sector. So we are developing a framework that is going to be advantageous to the investor, but also advantageous to the country. And here, as a government, to avoid even corruption processes of licenses, we have come with a mining portal that is the miningcadastre.go.ke, and we are saying here, don't come to the ministry, don't look for the minister, apply online, and you're going to get your response or your grant within 91 days of the process. And if you have applied and complied with all the requirements and procedures, then you are almost guaranteed. We are just awaiting a process for approval. Indeed. So that is an advantage, and that's the transparency we are bringing to the mining sector.
Indeed. Interesting conversation, Mr. Balala. I appreciate your time this evening. Thank you joining us there live from London. Now, let's move on to South Africa. The Tourism Business Council has released the findings of its second impact assessment study on South Africa's new immigration regulations on the travel and tourism industry. Now, these two issues are causing quite a bit of concern, and the two main ones are the biometric application forms for visitors to South Africa and the need for children to travel with unabridged birth certificates. As Angelo Coppola reports, it's not good news for the sector.
The tourism minister's hands are tied because the laws are implemented by the country's Department of Home Affairs. And while there appears to be an interministerial committee looking at legislation, there are no timelines set. The impact of the unabridged certificates can't be measured yet either because it's only been a month. In the meantime, the industry and the country is suffering because of the biometrics requirement. Just in the last 6 months, there's been a huge loss.
The South African economy directly lost 900 million rand. That's directly, but if you add in the direct, indirect, induced component, that's 2.6 billion rand in our economy of lost spend in the country.
The problem is exacerbated with tour operators who print brochures. They need long-term certainty about visas and birth certificates. They also have long deadlines and big print runs.
What happens in a brochure environment, for example, because you only publish it every 18 months, and because it's always changing in South Africa at the moment, it's very difficult to update it. So sometimes what happens is that a tour operator may just choose to take that out because of the difficulties around continually applying for visas or updating that information.
The TBCSA wants the unabridged birth certificate scrapped and replaced with a standardized consent form. It also wants biometric data collection on tourists' arrival and/or e-visas. Thirdly, the Home Affairs Department has to do a communications campaign to undo the confusion it's caused. It's the industry that's going to suffer, though.
All the work that South African tourism is doing, Brand SA, all the private sector members that are putting money, it's all going to waste because people are looking at it and saying, yeah, wonderful package to South Africa, but you know what, I'm not sure what are the requirements for me to travel to the country.
The tourism sector in South Africa is seen as one of the primary employment generators in the country, and yet it's being treated like an orphan. It's not being given enough attention, and it appears that at least one government minister is not doing what he can do to ensure that there's more employment created and more foreign direct investment coming into the country. I'm Angelo Coppola for CCTV in Johannesburg.
Let's make a quick run through the markets here for you. Fairly subdued numbers from several of the markets that we track here, with the exception, of course, of the JSE in South Africa. The 20-share index in the Kenyan capital, Nairobi, relatively flat on the day. Interesting developments, however, on National Bank. By its own admission, by the end of March, it was in violation of the mandatory ratios of total capital to risk-weighted assets. But nonetheless, the company is putting up quite the brave face in Kenyan media. It's a fascinating story to follow. We'll give you updates right here on Global Business. Eurozone leaders are hopeful of a deal aimed at easing the Greek crisis. And Egypt orders production of local digital converters in order to cut the cost of migration for consumers. Africa is on the move. It's home to 7 of the world's 10 fastest growing economies. We help you make sense of the fast-changing African business landscape. We take you where the business is happening. Global Business, weekdays at this time on CCTV Africa.
This is the first year that Africa will have more foreign direct investment than aid. And it's like the tipping point in terms of changing the way the continent is perceived. And I think this summit very much responds to that call. Now, whether it can materialize what is being announced is something that we'll have to check and see whether it happens.
Welcome back to the program. Now then, let's move on to a question of digital migration. Egypt is one of a number of African countries that has failed to meet the global deadline for migration from analog to digital transmission systems. Now, while many residents have already converted to digital TV, as Yasser Kim reports, it's estimated that roughly 7 million households are still watching and receiving analog TV signals, and many can't afford the upgrade.
Officially, Egypt has not completely migrated to digital television yet, but it has been operational for years.
Egypt can migrate to HD. Private and state channels already offer HD service to their viewers, but it's optional beside the main analog transmission, because many people don't have the receiver or converter yet.
According to a local survey, 7 million households still need to buy converters, receivers, or new digital TV sets to receive the digital transmission. Due to the latest uprisings, Egypt was given an extended deadline before switching off the analog transmission.
The infrastructure is there. Egypt is highly developed in media. The problem is that citizens are suffering economically and can't afford to buy new sets or converters. It will take time.
This year, the government allowed companies to produce the receivers and converters locally. It aims to make it available to consumers at a lower price than the imported sets. Egypt is the hub of media in the Middle East on North Africa, but most Egyptians are not aware of this transformation. An awareness campaign is needed to convince Egyptians to put their hard-earned money into a new converter or TV set. Yasser Hakim for CCTV, Cairo.
On to matters further afield now. Greece has moved a step closer to reaching a deal with the European Union and essentially her creditors over a potential deal to avoid defaulting on its loans. Greece's government has presented a set of new budget proposals to unlock frozen aid and avoid defaulting on a €1.6 billion loan to the IMF. The European Council says that the move could lead to a cash for reform package by the end of the week. That said, the Greek Prime Minister, Alexis Tsipras, now has a fairly tough job in front of him. He's got to convince many residents who voted for an end of austerity measures that these reforms are necessary, a bitter pill, if you will. If Greece's parliament fails to back this latest offer, and that includes a series of higher taxes and changes to welfare payments, the government may be forced to call an early election, and that will essentially prolong the uncertainty we've seen coming out of Europe.
After all this, I now have the feeling, to use the phrase usually used by the EU officials, the ball is in the European leaders' court.
An enormous amount of work remains to be done. This is certainly not the end of the road.
I'm afraid that these proposals will not pass in Greece. And all this is happening so that they gain time, and at the end we'll be back here again. Only we will be outside the Eurozone.
Now then, let's get more details on those talks and the review of Greece's proposals. Jack Barton joins us now live from Brussels. Jack, if the Prime Minister, Alexis Tsipras, doesn't get parliamentary approval of his proposed measures, what happens next beyond just having a snap election?
Well, it's going to be very difficult to get that approval. Many in his own party have already said they're not going to pass these concessions as they stand. And over the next few days, we're going to see more negotiations. There's going to be more concessions added. There's no doubt about that at all. Already, some of those red lines have been crossed, such as on pensions, cuts to pensions, or actually phasing out early retirement schemes, but also on the value-added tax, raising that. They were told it won't apply to electricity and medicines. They were clear red lines for the party. And some members say they're just not going to accept this bill. So Alexis Tsipras is going to have to reach out to the opposition if he wants to get this passed. At this point, it's really too late for a referendum or a snap election, because that big repayment of around $1.8 billion is due to the IMF at the end of this month. That is very close, far too close for either of those options. So really, if it doesn't pass through at this point, the only real option would be to default on the loans. But it's important to remember that it's not just the Greek Parliament that needs to pass this. Even if it's agreed to these concessions at a European level between all the leaders, other countries will also have to pass it, not all but some, including Germany.
Indeed, and Germans, of course, will be a completely different kettle of fish altogether. But now that these proposals have been made, walk us through what will happen tomorrow when the Euro area finance ministers come together.
Well, the proposals have been made. The first step is they go through what's called the institutions, the International Monetary Fund, the European Central Bank and the European Commission. And that's where they've been today. So Greek officials have been walking those proposals through with the officials. They essentially told the Eurogroup ministers, we didn't agree with any of this, we agree with some of it, or more work needs to be done, or this is all good. From what we're hearing, we haven't been told exactly what they think, but certainly from what we're hearing from officials, or the mood out there, is that this is very close. A little bit more needs to be done, but it's getting very close. So it will then go to the 19 Eurozone finance ministers. They will try and close some of those gaps that are remaining. There will be technical talks. They'll go through the details. They'll want to know some of the prior actions that Greece will put in place before the deal is actually signed. And if there is enough movement there, it will then go into the Leaders' Summit. Even at the Leaders' Summit, there's usually one or two small changes they still require. There's phone calls backwards and forwards to the various capitals. But most of the movement we're expecting tomorrow. And from what we're hearing, the expectation is things are going smoothly. There could be a deal in place by Wednesday. But even if that happens, of course, this is just for the 8 billion euros. That will get Greece through to around about August the 20th, most of that money going to repayments. Even if it gets a good deal, a 6-month extension of more than 18 billion, that's still going to get it just through the next 6 months. So at some point, we're going to be back here, either at the end of August or in 6 months' time.
Indeed, kicking the can down the road, so to speak. Thank you for your input. That's Jack Barton live in Brussels. A quick run through commodity prices. Not much change from the trends we've seen on crude oil and, of course, gold over the last couple of trading sessions. Both down slightly in trading today, by over half a percentage point. Now, authorities in Zambia's capital want to clear thousands and thousands of tons of garbage which has been choking the city's streets. Not entirely new, that's fairly normal. Here's a bit that you normally tend to hear about. They also aim to use that garbage to generate electricity.
Lusaka's city streets have long been an eyesore, its sidewalks covered with mounds of garbage. Previous strategies to remove the buildup of rubbish have been largely unsuccessful, but better results are hoped in future.
A lot has been said about finding a lasting solution to this problem, but not much has been done, especially to my knowledge. We are here to review the efforts we have applied in the past to tackle the problem and see if there is anything we must do differently from what we have been doing in the past.
The status of Zambia's capital city as an emerging business hub has helped create greater impetus to find a workable solution to the waste management problems. Authorities are concerned the unsightly garbage will scare away potential investors.
I want to inform all of you, as we start discussing on how we can have a lasting solution, I want to declare war against garbage. I want to declare war against garbage, at least in Lusaka province.
Lusaka produces about 1,000 tons of waste every day, and an estimated half a kilogram is produced per person each day. However, an innovative recycling business is being launched. If it is successful, not only will it help rid the streets of the garbage, it will also produce green fuel, boosting the city's energy supply.
We are in the process of improving on recycling of waste and material recovery from the waste stream, so that we can add value to the waste. We can generate energy from the waste, and we can actually generate fuel from the waste and cut down on the cost of fuel.
Despite authorities' best efforts, Lusaka will lead its residents and businesses to get behind the drive. If this city's streets are to be transformed into a cleaner, green and more attractive city. Robert Soy, CCTV.
Quick run through currencies here for you. The Naira, of course, still hovering under 200 to the dollar on the official market rates. The Kenyan shilling, of course, still displaying quite a bit of weakness. 98.60, the relevant number that we're seeing today. It's been sliding against the American dollar for the last couple of trading sessions. Now, here's what we're working on for tomorrow's program. We'll be focusing on the gold wage negotiations between unions in South Africa and gold mining sessions. The first round of talks should be wrapped up on Wednesday. Anxiety is rife, a deal may not be reached. Unions had indicated a fairly hardline stance ahead of these talks. We'll have details and analysis on that live from Johannesburg. And of course, investors and government reps in that mining summit in London will still be continuing with their talks. We'll be focusing on Zimbabwe tomorrow. The government there is pinning quite a few of its hopes of a turnaround economically on its mining sector. All that and more is in the pipeline tomorrow. You will be with Beatrice Marshall for the day. But that's it for this edition of Global Business. As always, we value your feedback. globalbusinessafrica@cctv.com is the email address to use. As always, the news continues 24/7 on Facebook and on Twitter. We'll see you there and in 23 hours. Thank you for watching.